Hello and welcome to this pre-scene analysis video from Astranti Financial Training. In this video I'm going to be going through the pre-scene materials for the February 2017 management case study exam, and the case company is Menteen. My name is Richard Lewis. I'm a writer and a tutor here at Astranti. I began my career about 20 years ago as a business journalist, doing financial reporting mainly, and then became an industry analyst, briefing CEOs and chairmen on industry trends in consumer behaviour, in supply chain, marketing, IT and finance. And now I'm going to take you through this pack. So let's just get right into it. We'll bring up the first page here and look at the company background. So the first thing I want to bring out is it says here, you're a financial manager employed by Menteen Studios. Now, as a financial manager, it's important to note that you're not deciding strategy at Menteen Studios, but you're informing it. So the work that you do is going to be involving making recommendations to your senior managers. That's what the job is. All right, let's move on. You're employed by Menteen Studios, a company that makes feature films. Okay, so we're dealing with the cinema industry, the film industry, and when we think about the film industry, what one word is synonymous with the world of big budget films? You guessed it, it's Hollywood. Hollywood is the global center of the film industry, and the thing about Hollywood is that it's in Los Angeles, in California, in the United States, and that's important for us because Menteen Studios is in B-Land, and B-Land is a country in Europe that is not part of the Hollywood oligarchy. So let's just rewind a second there. Hollywood is an oligarchy. We know from our studies an oligarchy is a market dominated by a few large players, most of which in this instance are in the US. And one of the characteristics of an oligarchy is that it puts up significant barriers to entry. Okay, so that's a few things that we know already. Let's dig in a little bit deeper. Okay, it says Menteen quickly grew to dominate the European film industry, so we know that it is a major player in Europe, but we know more than that. It says that it is the largest filmmaking company in Europe, and not only does it compete in Europe, but it produces and distributes films globally. Okay, now let's pick that apart. When it comes to making films, first you have to make the film and then you have to take it to market. So production is about making the film and distribution is about taking it to market. Now, in the film industry, these two functions are often separated. You'll have production companies and you'll have distribution companies, and the distribution companies will work with production companies and they'll make a deal together to take films that the production companies have made to market, to the cinemas, okay, and to other areas. Now in this instance with Menteen, much like the Hollywood oligarchs, it is a vertically integrated company, so it handles both production and distribution. Now, the production of films involves an enormous amount of assets. You've got to have the studio, the lighting, the sound production. You've got to hire highly paid acting talent, directors, and all kinds of other creatives. Basically, it's an enormous cost, the production, whereas distribution is asset light. You don't really need much at all to do distribution. It's about making deals with people. Okay, so you've got this vertically integrated player with one aspect of what it does that requires huge amounts of assets, some of which are buildings and plants and materials, and some assets are things like intellectual property that it's had to buy in. And then you've got this other aspect that's asset light, and these two things are merged together. So there is an opportunity, of course, for devices like spin-offs outsourcing, demergers, that sort of thing. So for example, if Menteen decided that it had too much risk in its production business, it could spin that off as a separate entity and start producing for other companies and keep its core distribution business as an asset-light vehicle. Okay, so that's an opportunity. Or it could outsource production to other companies and sell its production facility to raise money. Okay, so if we now circle back to this aspect, Menteen produces and distributes films globally. So straight away we can see that Menteen, although it's a European company and dominates the European film industry, it actually has to compete with Hollywood in the global market. Okay, and that to some extent explains why it has become a vertically integrated, asset heavy player, because it has to adopt a similar structure to the companies that it competes with. All right, now it's grown to become this large entity largely by acquisition of other major studios. Okay, now when you are going to grow by acquisition, then it stands to reason that you're going to need a lot of finance to fund your acquisitions, as well as the finance that you need to fund the production of your films. And as we've seen, the production of films involves an awful lot of money. So this is a company that for which finance is a major concern. So I would want to have a look and see what its debt levels are like, because it may well be that it owes an awful lot of money to an awful lot of lenders, because a company that needs that amount of money is going to be in the pockets of all kinds of people. Okay, so while we're on finance, let's just have a look at this bit. We can see that it's listed on the Bilan Stock Exchange. So at some point it's floated itself on the stock market to raise equity finance. And where you have a company that's publicly owned like this, first of all, you've got this devolved ownership, meaning that shareholders can influence strategy. So you need to find out who are these shareholders and what are their interests and motivations. Now, for a company that grows very slowly in a steady market, something like cosmetics or something, then you might see a lot of institutional shareholders, because it's a fairly safe stock and you can more or less rely on very slow, steady growth. So it would be appropriate for a pension fund or something to invest in a company like L'Oreal. But this is the film industry. Film companies make duds every year. They cost millions and millions and millions of dollars to produce, and they flop at the box office, and a lot of people lose their money. So this is a high risk stock, and where you've got a high risk stock and a high risk industry, then investors are obviously going to be quite nervous. So it might be quite hard for Menteen to attract institutional investors. It might be difficult to attract long-term investment. So it may well be that the type of investor that's got that kind of appetite for risk is really looking for quick returns. So that's an issue for Menteen. Who is going to invest, who is going to finance them, and what sort of returns are they looking for? The other issue around a public company that is traded on the stock exchange is that, of course, you've got, from an accountant's point of view, you've got the cost of compliance with regulatory standards. Okay, we see that it adopts the IFRS standards. Okay, and it trades in the Bilan dollar. Okay, so there's some currency risk there. It's not trading in euros, so it's one of the largest companies in Europe that's not part of the Eurozone. So what is the implication of currency risk there? That's quite an important factor, to be honest, that may well come up in the exam. And then the last aspect, of course, with a public company is the fact that share prices are going to be affected by strategic decisions that are made, and share prices can be affected not only by strategic decisions but by a wide range of pestel factors. These are the external factors that Menteen can't necessarily influence, like, for example, its near neighbour, the UK, voting to leave the European Union. What does Brexit mean for Menteen? Does it have interests in the UK? A lot of film companies, if you look at my industry pack, a lot of film companies are involved in co-productions in the UK for financial reasons, and so there's some risk there. Now, the material also tells us not only does it produce and distribute films globally, it also owns a large library of film content. Now, a lot of film studios, film companies do own large libraries of content. What does this mean? Why are we being told this? Well, look, film companies, much like any other content creator, like a publisher, deals in front list and back list. Now, front list is your new title. It's the latest thing. It's the thing that you're putting all your money into promoting. So when you make a film, the goal is to get as many people into the theatres. In the film industry, cinemas are referred to as theatres, but it doesn't mean it's a stage play, it's a film theatre. The idea is to get people into the theatres buying tickets at the box office, because that's where they make their large profits, okay? It's a high profit sale. So an awful lot of what the distribution part of Menteen is going to be involved in is publicising the new material to try and get people into the theatres and buying those high profit tickets. That's your front list. But obviously, when a film is produced and people go and watch it in the cinema, at some point it's going to be displaced by the next new thing, and that's when it becomes part of the film company's backlist. And your backlist is basically last year's sorry about my wobbly line, last year's big hit. And not just last year's big hit, but those big hits from 20 years ago, from 30 years ago. They all form part of your backlist. Now, the question is, if you are spending all of your time and money promoting the front list to get people into the highly profitable cinema revenue stream, then what are you doing with your backlist? Well, usually a company's backlist is going to go to the home video market. This is used to be VHS videotapes back in the day. Now it's DVDs, and increasingly the home video market includes and is to some extent being displaced by on-demand streaming video. Okay, so what emerges from this is that Menteen has two major revenue streams. Okay, one of course is the theatre market, and the other revenue stream is the home video market. All right, now the on-demand streaming video revolution that's happening in the world of film brings us neatly onto this one. Menteen, it says here, was founded in 1936. Now, it's an awfully old company. Actually, most of the large players in Hollywood were founded either just before or just after 1920. So this is relatively young for a large film industry big gun. However, when you've got a company that's that old, not only is it likely to have very valuable intellectual property, would help if I could spell it, very valuable intellectual property that includes not only the content but all kinds of brands, okay? And the film industry is all about the trading of intellectual property. When you make a film as a production company, you've got to get your idea from somewhere, okay? And usually what you're going to do is buy the right to a story or a character or a situation from the writer or the creator of it, and you will then have the right to exploit it throughout your various entertainment revenue streams. Okay, so it's likely to have in this large library of film content some very valuable properties and also some very valuable brands that it can exploit almost endlessly in one way or another. But because the company is so old, then there is the risk, we don't really know, but there is the risk of a highly ingrained culture which tends towards the status quo rather than being agile and adaptive to market changes. And this is important because if we circle this back up to where we came from, we've got this issue of on-demand streaming video, which is threatening to disrupt the film industry. Okay, so let's try and sum up some of this using some models that we're familiar with, all right? Okay, let's look first of all at Porter's 5 forces. In this market, competitive forces are high. An established oligarchy, so Menteen can't raise its prices, it can't charge more somehow in a cinema for a film that it's produced, okay? So it's limited. Whatever rivals do, it's going to have to follow suit. Now, the threat of new entrants, initially, we would say that it's low because it costs so much to get into the film industry, and these large players, the oligarchs, have locked down the market with these vertically integrated studios and producers and distributors. It's difficult for new entrants to get into that market. There are high barriers to entry. That said, threat of substitution in the film industry is high, because are you going to go and watch a film, or are you going to go out to dinner? Are you going to watch TV? And this is where we get into the strange grey area between these two forces, because although the threat of new entrants into the studio model is low, the threat of new entrants into the backlist part of the market is high, because Netflix, Amazon Prime, Hulu and all these other on-demand streaming companies are forcing their way in and actually increasing the threat of substitution, but also creating competition for front list as well. Are you going to go and watch the big budget film in the cinema, or are you going to watch that new thing that Amazon actually commissioned and is streaming on Amazon Prime, which is new? Okay, so there's a little bit of a grey area there. When it comes to the bargaining power of suppliers, this force is quite low in the film industry. Let's say you're a writer and you've written a script. How interested is Warner Brothers in turning it into a major blockbuster? It's going to be quite hard even to get a meeting, let alone negotiate a good price for yourself. There's a high amount of supply and there's a low amount of demand because of the oligarchic nature of the market. Then we're dealing with very high power gatekeepers. So bargaining power of suppliers is low. So it follows that the bargaining power of buyers is high, or at least it's high if you're the studio. So for Menteen, as a buyer of intellectual property and other kinds of inputs, it's quite high. If you're the consumer buying a cinema ticket, it's very low. You can't influence, you can't go into the cinema and say, well, I'll offer you £5 for it instead of 10. That's not happening. So that is the industry through Porter's 5 forces. Now, if we have a look at what we've learned via Mendelow's matrix and look at the power of stakeholders, let's have a look at the different types of stakeholders on the matrix. Okay, now our low power, low interest stakeholders are going to be the consumers. They've got low power because they've got no influence over what gets made, and they've got very little influence on how much it costs. I say they're low interest because they are distracted by 1,000,001 other things. There's 1,000,001 other things to spend your money on. There's a very high threat of substitution in the industry. So in that respect, they're low interest, low power. And so you want to focus minimal effort there. The stakeholders that have a high interest but still have low power to some degree are the creatives, the actors and the crew. So they have a low bargaining power, as we discussed here, and so they would go on that part of the matrix. Our regulators, for example, the financial reporting regulators and so forth, will be in low interest, high power. They have the power to sanction you if you're not doing things correctly, but they're not that interested in what you're doing in your industry. What stands out about this particular case study is the sheer number of high interest, high power stakeholders. So the shareholders, obviously, with a public company, your shareholders are going to have high interest and high power. There are also your lenders, the banks in this instance I'm talking about, okay, that are going to want their money back plus interest. We've got other types of investors that may be all kinds of different investors, private investors that are bankrolling your film production, private capital companies that manage private investors and so forth. And then there are the guilds and the unions. Now, the important thing to note here is that the film industry is more or less the most highly unionized private sector industry there is. Every single type of profession involved in the film industry has its own guild or trade union. Okay, so you get the Screenwriters Guild, the Actors Guild, the producers, directors, even the people that operate the lighting and so forth will have their own unions, and there's a lot of power behind those unions. They can take their members out on strike, as they often do, and it actually can bring production to a halt. Then lastly, governments are high interest, high power stakeholders in the film industry. Now, governments aren't usually high interest stakeholders, they do have high power, but in this instance governments are high interest stakeholders because they provide an awful lot of funding. They have an interest in a national film industry because film is a valuable export, it's a cultural signifier, and it provides an awful lot of employment within the country. And so governments in this instance are going to be high power, high interest stakeholders. Okay, so there's a lot of areas here where your company is going to have to keep people very close. So what does all this mean for you on an exam day? Why is the examiner giving us the information that it has? Let's just circle back to the beginning and have a look. I think the examiner, in choosing Menteen within the film industry, wants us to consider the threat of substitution that is inherent in this industry that we've already identified here. I think it wants us to. I think the examiner wants us to consider the particular competitive rivalry and the fact that the company cannot do anything to raise prices. So you've got to find other ways to get around that. I do think that the examiner is asking us to look at mergers and acquisitions, and particularly financing via spin-offs and so forth. I think the examiner wants us to look at assets, what assets can be used to raise finance and what assets can be stripped out of the company. I think the examiner wants us to look at currency. That's one of the main reasons, I think, for having Beeland with its own currency within Europe, which is most of the countries are in the Eurozone, Beeland is not. And lastly, I think that in choosing the film industry, the examiner has found an industry where we have a particularly interesting set of high power stakeholders, and that can have all kinds of implications: human resources, ethics, finance, and even politics. Okay, so this is why I think the examiner has given us the information that we have, and I think that's where you should focus your thoughts as you go into the exam. Okay, so let's move on to the next section in the pre-CIMA materials. Okay, I'm going to cover just the next 2 pages in this particular video. So in this section, the pre-CIMA is telling us about the filmmaking process, and the first stage in the 5-step process is development. I think the key phrase in this first paragraph is the fact that the examiner is telling us that Menteen invests considerable time and money in the identification of potential ideas for films. That means there's lots of money on the table before anything saleable even gets made. So this is a risk-based question, isn't it? The next bit of information I want to pick out here is where the pre-CIMA tells us, first of all, Menteen has to consider the potential audience for a film and the cost of producing it, which is like a very standard kind of commercial consideration. But then they say there are also these secondary considerations, such as the potential merits of the film as a piece of art and the possibility of recognition in terms of prizes. Now, how important are these things? Well, to get a sense of how that is interrelated, we look at this paragraph here. The artistic qualities of film may have a bearing on its commercial possibilities, because the pre-scene tells us it may be that the best actors are going to be unwilling to act in the film unless they think it's going to have some artistic merit. Okay, so we need to look here at the enormous cost of attracting and acquiring the best scripts, the best franchises like Star Wars or Harry Potter, the best directors, and so on. And this is all because at the end of the day you've got to get people on seats in the theatres, and the films are unlikely to attract an audience, it says here, unless they feature suitably famous actors in the leading roles. Okay, so everything is geared towards getting the very best people possible. Okay, and that means that we're looking at a huge startup investment in every project, including, by the way, the projects that don't make it through to production. Okay, it's not possible for Menteen to do a quick and dirty thing that sells really well. Okay, where you've got this huge startup investment in every single project, then there's no scope for the cheap and profitable sort of thing where you get very cheap inputs in from somewhere, you add some value to it, then you put it out at an enormous markup. That's not the kind of value chain we're dealing with here. Input costs are going to be enormous, and the fact that every single project requires this very different investment, then there's no scope for any kinds of economies of scale in the development process. It's not like you can hire in 1,000 best actors and get a bulk discount from the supplier. That's not how it works. Okay, you're dealing with individuals, you're dealing with high value talent. Okay, so that's the key point there. Still in the development phase and related to this is the idea that you have a heavy investment in intellectual property in order to create the scope for future film projects. What this means is that the film studio, Menteen, is going to buy up the rights to exploit some kind of franchise, let's say Paddington Bear or Star Wars or The Hulk, and owning those rights gives them the option but not the obligation to produce a film. Now, key point here is that when you're buying a film option from a rights holder, a writer for example, that rights holder gets paid for that option whether the film is produced or not. So we've got a situation where not only is the studio buying in inputs right at the start, but they're buying in the kinds of inputs that may never get a return on the investment. So where you've got no ROI, or no guaranteed ROI I should say, you've got very significant risk again. So risk and risk. Let's carry on. What else can we pick out from this particular section? Down here in this paragraph, the pre-scene tells us it can be difficult to predict the commercial success of a film, which introduces further risk. The next sentence is that costs can be difficult to budget. What does this mean? Even more risk. Audience demand can be unpredictable, it says. So we're starting to see a picture that doesn't look too exciting if you're an investor. What the studio is saying to you, let's imagine you're an investor and the studio producer has come to see you, say, okay, this film is going to cost us X million just to get the rights, X million to get this director, X million to get this actor, and X million to get this other actor on board. But, you know, it might not work. Would you like to invest in it? It certainly wouldn't appeal to me. I'm a very risk-averse kind of investor. What we do know about investors that have a large appetite for risk is that they tend to demand a high return. High risk equals high return. That's how it works. So that means that when Menteen makes a film, the investment finance that it's able to attract must deliver the returns that the investor is looking for. And that may in turn limit the profits that Menteen can make. So the next paragraph attempts to show us how studios like Menteen attempt to mitigate risk. And the way that they tend to do this is by using what's referred to as the comparables approach. And what's meant by the comparables approach is really just a case of looking at a project that's being pitched to you and comparing it to something similar that was successful. So they've given you the example here, I can't think of a better one for now, is when you say Alien was pitched to a studio as Jaws in space. It's the idea of saying, okay, it's like Harry Potter, but in a spaceship. It's not scientific. So we're really into high stakes gambling at this point, aren't we? It's really not something that can be measured very well. Okay, and then the last paragraph, we're told that studio executives will look at proposals from a number of producers before making a final decision as to which films will go into pre-production. So what we see here is a picture of a large company with a number of producers working there that are going to go out. They've got some kind of budget perhaps, and they go out and they're going to acquire rights, options, and try and bring a project to their bosses and say, make this one. And the bosses will go, no, not that one, not that one. Okay, we'll do this one. It means that a lot of money gets thrown away right at the start, and they only go with the one that they feel has the biggest chance of success. In terms of cash, it's very wasteful. Where you've got a situation where a company needs to have a lot of ready cash to throw around on projects that might never come through, then obviously you need to be looking very carefully at the company's cash flow situation. So all in all, I think that the 2 points to come out of this page are high startup costs, high risk, difficulty of attracting investors, and then point 2 is the need for very healthy cash flow. Because if the company doesn't have ready cash that it can throw around, then it can't make investments in all the projects that it needs to do to find the one that's going to be the golden goose. Okay, now the next stage is the pre-production stage, and in this stage the producer is going to hire the very high value members of the team, the director, the cinematographer, the production manager, the designer, the key cast members. These are going to be the stars, the Tom Cruise, the Jennifer Lawrence and so forth. And the thing about people like Jennifer Lawrence and Tom Cruise is they don't get out of bed for less than X amount of money. You can't get these people on board unless you're willing to actually stomp up some cash. So that begs the question, where do you get the finance from? You haven't actually got your key people yet. So if you're going to an investor and you say, well, I want to make this amazing film, and maybe we'll get Tom Cruise to do it. And the investor says, well, get Tom Cruise to do it and I'll fund it. But until you've got Tom Cruise, it's not much of an investment for me, is it? So how do you get around that catch-22 situation? So I think this is possibly a finance question. If you look at my industry pack, I do go into details about how film companies do manage that, but that's in the industry pack, not in this pre-scene video. Of course, the trick there is that if you go to Tom Cruise and say, well, you know, I need you to be in this film, otherwise we're not getting funded, he's like, well, you've got a film that's not financed? I don't think I want to commit to that. Tell me when you've got the finance to see this through and I'll agree to be in it. So this is a really tricky stage, the pre-production stage, okay? And finance is absolutely key to it. You need to find some way around that. Now here, the examiner is reminding us that in the pre-production stage, there's going to be a production schedule and a budget. Part of the producer's job is to cost this out day by day. shot by shot, in fact, and you need to be planning very tightly because time is money. These actors don't come cheap, and these film crews and these lighting crews and the enormous mobile studio that you need to bring to this location that you've scouted out, they all cost money. And if you don't get the shot the way you need it on the day that it's planned, then it might cost you double. So this is an important element that the examiner's just thrown away at the end of a sentence, but it is absolutely huge, because the question here is what happens? What happens if production is slowed? What are the contingency arrangements can you put in place? So this might be a question around scenario planning. Is it more cost effective, for example, to have a spare lighting rig on location just in case you need it? Or is it more cost effective to try and wing it and hope that you never have to hire one in? And if you do have to hire one in, can you hire one in that location? Is there a supplier there that you can develop a relationship with? If you do decide that you need that extra capacity on hand just in case, then what are the environmental considerations and the cost considerations? So we're into an element of CSR, corporate social responsibility in this instance, aren't we? Because that's a big deal. The amount of energy that a film production requires is a big issue for the industry. Hollywood is one of the biggest polluters in the world when it comes to energy consumption. And so you've got to weigh these things up, and probably you have to weigh them up at the pre-production stage. Okay. And then the last little sentence here that the examiner's thrown in, it says the executive directors will conduct a final review of the budget before production starts. So it may be that you get this far into it as a producer, and then your directors say, I'm sorry, you're going to have to cut your budget by a third, and then what do you do? What's the implication there for the inputs that you're trying to bring in? Where do you make your cuts? You can't cut the salary of Tom Cruise without a massive fight with his agent, and sometimes actors will take a pay cut if there is artistic merit in the film. Oh, and now we're back to that original sentence. So you see how all these things are tied together. Tom Cruise might say, well, look, all right, I'll take a pay cut as long as Woody Allen's directing it, because we respect Woody Allen, we want to be part of his cultural heritage. It's an artistic film, and as an actor, I know that he will push me, and I'll be proud of my work. But if it's that guy that did the wacky comedy about the Belgian policeman that went straight to DVD, then I'm afraid, there's not a chance. Okay, so now you see how all of these negotiations are interrelated, and they can change at any point. Very risky, very difficult to pin down. All right, so the next stage is the production phase, and we've covered some of this already. This is when you're actually going to assemble all of these people together, the actors, the director, the lighting, the sound, the studio, the sound stage, the cameraman, the cinematographer, everyone is together, and it is probably the highest risk element of the whole process because there are so many moving parts. So the key phrase here, the producer will take care to ensure the project stays within budget and on schedule. Okay, so we're back into that element of scenario planning and contingencies, and what could go wrong? Well, let's just think about it. We've got a scene being shot in which Tom Cruise has to film a helicopter crash. Now that's a fairly high risk shoot that you need to do. You've got a very expensive talent involved, and you've got a very expensive piece of machinery that you've got to blow up. So you've got multiple safety scenarios and multiple cost scenarios all in that one shot. First of all, obviously you're not going to put Tom Cruise in the helicopter. You're going to get a stunt man in. What happens if the stunt double dies? Do you have a stunt double on hand just in case? It's not quite that simple, because if someone dies on your film set, then you've got more than the logistical issue of how you replace them to deal with. It's a tragic piece of news that's going to have a significant effect on morale, and you're going to have to halt shooting and deal with all of that. Who is managing that? How competent is your team, your management team on location at handling that? Can you draw a line around it and carry on shooting, or are you going to have to stop things? What happens if the stunt double died in the helicopter crash due to our negligence, something that we did wrong, that we managed incorrectly, or we didn't put the safety contingencies in place, and it's our fault? Then not only do we have to deal with the human tragedy of it and the morale issue on set, but we've also now got the risk of legal action. Okay, that's a possibility. Someone gets injured or someone dies, and it happens actually every single year. Someone will die on a film set, so it could happen. It's not just a kind of exaggerated example. Then you have the risk of significant legal action. But if you've put your cast and crew at risk in any way, then you not only have risk of legal action, but you've got the risk of industrial action by unions. We mentioned before that the film industry is very highly unionized. Let's say that you didn't do all the things you were supposed to do. What happens then if the Actors Guild and the Producers Guild and the Directors Guild and the Film Crews Guild all put their members on strike? What do you do then? So we need to be thinking around this. So all of that can be pulled out of, stays within budget and on schedule. But I think the examiner wants us to look a bit deeper than just the economic implications of it, the risk of legal action and union action, what happens there. But there's also, you can look at it through the lens of ethics as well. If you're cutting corners on things like health and safety, then it's not just a cost concern, it's not just a risk concern, it's also an ethical concern. So you need to be, if something like this does come up in the exam, then I think you want to show the examiner that you've considered it from both angles, from the economic perspective, but also from the ethics perspective. Now I've highlighted this section because if you do get into a situation where production is significantly delayed, then your downstream partners are going to have some issues with that, aren't they? Now, Menteen is fully integrated with production and distribution, so maybe their distribution arm isn't going to sue the production arm, or maybe it might. You don't know exactly how these things are managed within the company. They might be operated at arm's length. But you've got the exhibitors to think of. The cinemas will have included the film in their own schedules, so there may be some kind of contractual aspect to it. If your production is delayed and you can't get the prints of the film to the cinemas on time, then you're going to harm the revenue of your exhibitors, and they may well come after you with their contracts for some compensation in that instance. Alright, well, what I find a little amusing about this particular pre-scene material is that we only get three and a bit or 4 lines on production, where it's the most logistically complex element of the entire process. It might be a little hint that the unseen materials will have things in it to do with production. Anyway, let's move on to post-production. There's a lot more written about post-production, but in fact in the real world industry, post-production is a less stressful time for the film companies because all the moving parts are taken away to some degree, and it's really down to the director working very closely with editors, sound editors, sound designers, CGI, animators, and so forth. But there's fewer moving parts, and all those high cost talent people have all gone home now, so you don't have the responsibility of them on your books anymore. That said, there's still quite a lot of work to do, and the pre-scene goes through these bits one by one. I think the real key point here might be around this aspect. When it comes to editing, it isn't necessarily the director who's going to get the final say. You may have seen these films, DVDs for sale that say, Blade Runner, the director's cut. And what that is, it's the version that the director wanted you to see, but wasn't able to at that particular point. The studio didn't think that his or her version of the film would have the mass appeal that a different version would have. So the studio can intervene here in the artistic process if it feels that there's something in the film that might narrow its appeal. So maybe the film is deemed to be too hard to follow, too complex, or just too long. And so there might be some shenanigans here, some disputes and arguments with the director. And then you would look to see what's involved in the contract there. And then in this second paragraph, we're looking at mainly sound elements. So the examiner has gone to the effort of telling us about different dialogue tracks being replaced, dubbing into different languages. So if you're a Hollywood film studio and you're probably going to be making your film in English, but you would be pretty silly just to limit yourself to English-speaking markets, especially when you think of the size and potential of markets like China and India. Now, within India, there are all kinds of languages being spoken just within that one country. And then within Europe, we also have many different languages that need to be dubbed on. So this actually could potentially be a costly process, and it could be a lengthy process involving multiple stakeholders. Okay, so let's have a look at the next section. Alright, now when it comes to marketing, the key point that I want to pick out here is this notion that some of the marketing efforts are going to be begun even in the pre-production stage. So what will generally happen is, let's say you've got Tom Cruise on board and you've signed him up, but you haven't begun anything yet. Then you start the press coverage and publicity almost straight away. You want to get him out onto the talk show circuit, talking about the new film that he's involved in, which is all very well, unless of course he's involved in some kind of scandal or something at this stage, because you're still trying to attract investors and finance and things. Look, it's a long shot, but it could happen. These celebrities can get up to all kinds of shenanigans. The next paragraph reminds us that film is probably going to be launched at different times in different territories. Now, there are good reasons for doing that. As the pre-scene says, it makes it possible to concentrate your publicity efforts in a particular country to maximise the impact of the launch. But we don't live in a territory divided world anymore. This is actually something that's a big issue within the industry. Yes, we live in different countries, but we have the internet now, and we can see American talk shows on YouTube any night of the year that we want. And so what happens is consumers in one country, let's say consumers in France, are going to be aware of a film that's launching in the US. Even though they don't have access to it yet. So the film may be generating masses of publicity. You probably see on YouTube some footage of the premieres, and you'll see critics talking about it. It'll be generating talk show material and so forth. And the consumers are saying, well, hold on a minute, I want to see this film now. And why do I have to wait 6 months until it's available at the cinema? And so what this introduces is the temptation to piracy. So the scenario here is that the consumer that's very tempted to watch this film but can't watch it yet because it's not released might decide to go to some kind of BitTorrent downloading site and download an illegally copied version of the film. Sorry, I can't spell temptation, sorry about that. There we are, just for grammar's sake. And they will get access to this film before it is available in the box office, and that means when it is released in France, they're not going to go and see it because they've already seen it for free illegally. And this is actually a major issue, isn't it? So when you are dealing with this staggered release, to some degree there's an argument that you are inviting piracy. Okay, that's an issue. The next paragraph talks about the fact that obviously cinema releases are going to generate healthy profit from box office receipts. You can charge a high ticket price and make a lot of money there. So that's where most of the films are going to make their main money back, okay? And then they're going to be looking at the additional revenue streams such as satellite and cable TV, and then eventually onto DVD. So if you've got a situation where you've got a film that's going straight to DVD for whatever reason, then you are going to be looking at significantly reduced profits. So the examiner might want us to be considering what might happen there if something comes up in the exam that means we need to go straight to DVD. What's it going to mean for the profits? It may even be that the film makes a loss. And then what do you say to your investors? Now the last paragraph here deals with another very important revenue stream for film studios, and that is the merchandising market. Now we saw right at the beginning that the studio is going to spend some money to acquire rights, okay, and normally what they will do or try and do there is acquire merchandising rights, and then they will have the right to exploit the intellectual property through merchandising. And the way this is done, the film studios doesn't make any products, it's purely a sale of rights, and it's asset light and high passive revenue yielding business for them. They don't have any risk there. The risk is all on the part of the manufacturer. So we're dealing with a low risk fee-based revenue that doesn't actually have any physical need for assets. So that brings us down to the final stage in the production process, in the film production process, and this is actually where the film is going to be shown in cinemas. It's known as exhibition, and typically the distributor is going to make a deal with the cinemas, and typically that is going to be a straight 50-50 split of box office takings. That's generally what it is, and the distributor is responsible for convincing the cinemas to book the film, but it's also responsible for supplying the cinemas with the marketing that they need to attract people into the cinema to see the film. So all those kind of point of sale advertisements that you see, the big billboards and all of that, is handled by the distribution part of Menteen in this case instance. And the distributor historically would have been responsible for physically getting the prints of the film to the cinemas in time. These days that aspect of it has been significantly reduced because really we're into digital content these days, so the distributor doesn't necessarily need to have a truck going to the cinema with prints of films that they then need to sort of get back off them. They can send digital content to cinemas. So that does cut down some of the cost and the logistical nightmare of that aspect of it. Now, the cinemas are quite high-power stakeholders in this business, and it's typical that deals will be done with the cinemas long before the film is ever produced. So if you've got a situation where the film is delayed, or the film never gets made, or doesn't get finished, or gets dropped or something, then you end up with some contractual difficulties with the cinemas, who are going to come after you for their lost revenue. So that's one aspect that we might be being asked to consider. Another aspect that's a possibility is, why does Menteen not vertically integrate the cinemas? It does happen. There is some precedent for it in the real world industry, and what you would achieve in the territories where you have actually acquired the cinema chains is that you will control the entire supply chain, from content acquisition, rights acquisition, through to content production, through to exhibition. And that would create not only barriers to competition, so that you might limit supply, or you might delay supply to competing cinema chains, so that you're going to get the lion's share of the box office revenue in your own cinemas, and of course, obviously, you would get 100% of the box office takings. Now, I don't know whether that's going to be appropriate when we get to the exam, but I think it's something that's worth keeping in the back of our minds as a possibility. Now, just before I go, let me remind you that this is not the end of it. We do offer a full range of support materials, including the study text and other course videos. We do the industry analysis, where we look at the real world industry that your case study is based on. We do mock exams around the case study exam, and we offer marking, feedback and masterclasses, all of which are covered by the Astranti Pass guarantee. So I'll see you in the next video.